The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we continue to dissect these markets here, midweek action was relatively mixed. We saw some firmness in corn and Chicago and KC wheat, a little weakness in soy, along with spring wheat, some weakness in feeder cattle, a little bit of a green in hogs as well. Felt like a quiet trading day overall, but plenty to talk about here in these markets. And joining us now for conversation, glad to have him back with us here this week, Mike Zuzolo with Global Commodity Analytics. And Mike, thanks for being here, my friend. And I know you were under the weather last week. I hope you're feeling better.
Took a short trip to COVID land and came back, Jesse, better than ever.
Oh, glad to have you back. Glad to have you back. And
Good to be back with you.
Yeah, it's an important time in these markets, too, to sit down and have a conversation, I think. We started the week with some good short covering, it felt like. Maybe some opportunities were taken advantage of by a few folks who were way behind on some of their marketing. There was some good price action, but then we kind of settled this thing down a little bit here midweek, and it feels like we're back to playing this giant game of chicken between farmers caught between funds who are short and commercials who are long, end users, et cetera. So, I mean, talk about this. What's your perspective on where these grain markets in particular are sitting right now, Mike?
You know, me personally, as we've talked about it over the course of the past few months, we've had this huge difference and differential between the world price of corn, the world supply demand of corn, and I'm using Europe and Paris corn futures. I always have been for the better part of a year, Jesse. And the idea that the funds have been short because of U.S. supply and fears of weakening U.S. demand, and that weakening U.S. demand's tied into the idea that we've got problems in China economically. They started to improve. They had a big third plenum meeting that was supposed to give us a lot of answers as to how they're going to meet 5% growth this year. And simply put, we got a little bit of an interest rate cut Monday. The market did not like that at all, and it's essentially been lower ever since. And so what we've been trying to do for the better part of the year is turn the funds' heads away from the big U.S. supply, the fears of China demand, and get them to look more at the global supply-demand fundamentals. And we started this week to do that because of the Ukrainian drought, because of the Canadian prairie drought, wildfires in Canada as well. And so we started to move, and nothing's going to move in a straight line. I don't think we're going to jump hard. We aren't going to see the funds really move quickly from one position to another. They typically never do. They kind of get out of short positions kicking and screaming. It would seem to me they're forced out of positions in the short side of the market, whereas with the longs, they're very easy to dump and dump quickly. And so this chart here really does explain to me where we're at this point as we cross over the threshold of midweek. And now we have what could be a U.S. weather market to join in with the world weather market. And so the question is Paris corn futures at over $6 and at over a $2 premium against the Chicago Mercantile Exchange price valid? And it's the widest since we've seen, since it would almost $3 premium back in July of 2022. Interesting to note that same time period, the spread widened so quickly. And you notice in July 2022, heading into August, we saw a real shift in the U.S. corn price, and the Merc rallied. And so we're trying to break free of that 2014 type mindset and the break to the downside and trying to rejoin with more of the global fundamentals. And it's a question more than an answer right now, whether we can do it or not. A lot depends upon the wheat, and a lot depends upon the U.S. weather here the next 10 days.
Yeah, we're going to talk more about that U.S. weather outlook here in a minute, I'm sure, as well. But very interesting to look at the correlation here between Paris futures and the Chicago board price for corn. And I want to pull up another chart and thinking about some of these world corn values and prices. This is looking at some more of those as well to kind of illustrate what you're talking about here. I mean, comparatively speaking to a lot of other countries and competitors around the world, I mean, that U.S. price has gotten down to some levels where I think it could spur some demand. Maybe I'll make that comment. But what are you seeing on this chart right now?
No, I think that's a really key point here, Jesse. We're above the 20-day moving average in the D's corn after Wednesday's close. We're not there in the November beans. And we've noticed the bear spread has been more active in the beans versus the corn. Wednesday was a little bit different, but we've got a demand issue in the beans that we don't have in the corn. And it really does go back to this price chart. And remember, what was it, Tuesday? We had a shot to the upside on Monday, and then all of a sudden Mexico came in and bought corn. And then we had an unknown purchase of corn of 200,000 tons. I'm wondering if that wasn't China. Why? Because the Black Sea price is going higher, and we know that there's some damage being done in the Black Sea right now because private trade guesses are going down. And it's not just the Ukrainian crop, and we're not sure about the Russian crop, but we do see the Romanian corn price here really taking a turn to the upside. So these prices, this demand that's coming together in the corn is very different than what we're seeing in the soybeans. And that's a big distinction in my mind because we don't have as much fundamental support in the soybeans as we do the corn, even with the wheat kind of dragging its feet and trying to weigh the corn down. The bottom line for the soybeans right now versus the corn is we've got a discount in the U.S. corn price versus the rest of the world. And I think that's because of the fact that the Brazilian corn crop is not there compared to the Brazilian bean crop. And I think that's going to be a really key player here in the next 2 to 3 weeks is what's the world cash prices do. And I'm not trying to say the oil seeds aren't getting hit right now with production hits. I mean, we saw Black Sea sunflower oil cash quotes move up to 1-month highs on Wednesday's trade. We're seeing the Canadian prairies really being looked at hard right now. So the rapeseed, the canola seed, all of these oil seeds are very key, and they can support the soybeans. And we have a Western corn belt that's got a very variable crop right now, and beans are not looking that great in some of the key areas of both the Western and Eastern corn belt right now at this stage of the game. So I'm not trying to shortchange the beans, but I am trying to say the corn just got a better global look to it than the soybeans do, and I think the market is picking up on that right now.
You brought up Brazil, and I think that's a good point here that we should talk about a little bit. And I'll pull up another chart looking at the Brazilian real. And I've heard some chatter that not so much, U.S. farmers. We do know U.S. farmers have a lot of corn in storage. Maybe not so much soybeans, but I've heard that Brazilian farmers have a fair amount of both down there. And so, that's some different dynamics we have to think about in this global market picture as well. Mike, talk about this a little bit.
Yeah, it really is. And I think this is where it goes back to when you think about China and you think about the soybean market, China has always underpinned the soybeans. And you and I've talked about this a lot about this year maybe being different because of the fact that we have these trade frictions. And so we absolutely have to have the currencies on our side, especially when it comes to the soybeans. And we're not getting that. We're actually back to the highest level in the dollar against the Brazilian real since January of 2022. And I think that really means something in this market. And I think this chart showing a very strong dollar against the Brazilian currency means a lot. And, the Chinese just came out with fresh data on imports from January through June. And they showed pretty starkly that the Jan through June Brazil purchases that they imported from Brazil in soybeans was up 16% in volume terms, but for the United States, that same time period, it was down 27% in volume terms. So I think that's the issue with the soybeans and has been for almost all year. Why are we at $4 D's corn, but we're sitting at 10.50 Nov beans when both of them are looking at surplus U.S. stocks to use ratios, not global, but U.S. stocks to use ratios. And so I contend and continue to promote the idea beans are the first to hedge. Beans have the most premium. Why? Because not only do we have ample supplies domestically, but we also have ample supplies globally. And if we lose the currency, we lose the ability to compete with Brazil.
And I think tying in with that as well, Mike, this chart looking at that world soy price, I mean, this can kind of extend off the thoughts you're talking about here, but just a lot of A lot of similar but different dynamics in the soy complex globally right now.
Yeah, and you notice that when we had the big strong rally in the soybeans this week, it was because canola was running 4% higher. And so we got to keep an eye, as I said, on those minor oil seeds. And we want to keep an eye on the meal as well. But if you're just looking at outright soybeans and you look at the prices, you compare this to that chart we were just looking at for corn, we are $20 premium roughly against both Argentina and Brazil right now in terms of soybeans at this stage of the game, Jesse. And so I think this is an important distinction and something that really, as I said, needs to be monitored. And I think this goes back to the Chinese financial problems. If I'm worried about China as we head into the U.S. election, and I'm worried about the U.S. stock market following the Chinese stock market, which has given up a lot of gains in a lot of their markets here the last week or so, I'd be worried about the soybeans and the hogs, that pork and bean trade. And I would say wheat is also feeling that pressure through the copper. We can't forget the idea that the soft red wheat and the copper trade very similar with one another pretty frequently. And in fact, since the mid-May highs in both, we're down about 20% in copper. We're down about 20% in soft red wheat off those May highs. And that May high was made about a week later in soft red wheat versus copper. So we really do want to try and attach together in this weather market environment the idea of the U.S.-China trade frictions and the weak China economy, because that's going to give us a better idea, I think, of how high is if we continue on this hot, dry pattern globally in the Northern Hemisphere.
We are joined today by Mike Zuzolo with Global Commodity Analytics. And Mike, I want to talk a little bit more about the weather picture here with you real quick in terms of these markets. A lot of the talk about heat and dryness in the northern plains creeping into spring wheat country here this week. The spring wheat tour is ongoing right now, finding good yields so far, but it felt like that was part of the equation, as we've kind of alluded to and you talked about here to some of the early week rally. I've seen some chatter on social media that some folks are saying, oh, we're going to have a flash drought to the Western Corn Belt and the Northern Plains. But at the end of the day, I still contend that the better weather in the central and eastern Midwest is outweighing any of the risk potential right now in other areas. This feels like it's that kind of back and forth seesaw of a weather market right now, Mike.
You know, I agree with you, Jesse, but in 15 days, I probably won't, depending on how high those temperatures get. And I think the big kind of dirty little secret in Chicago right now, and I had a great conversation with one of my colleagues on Friday when this Ukrainian drought issue started to get attention. And as I said, the heads of the fund started to get turned by the global picture. I talked to him and I said, you know, we've known about this for 3 weeks. Why are we just now looking at it? And essentially he said, because we just keep adding to the yield in the U.S. crop, especially in the corn crop. And I've heard 182, I've heard 184. I heard today someone say 187. And so if we've really put that kind of a yield on the table in the Chicago futures price, 15 days from now of 99 degrees in Des Moines, Iowa, and 0 rain, I think they'll have to dial that back. And I think that's really the key going into the supply side is, as I said a minute ago, whether the U.S. weather can join up. We know for pretty certain that we're losing supply right now, production right now in Ukraine. If I had to put a number on it, Ukraine's probably losing about 4 million tons from where USDA is at on corn production. Instead of being 28 roughly, it's probably closer to 23, 24. It could go below 20 and by the end of the month if we stay hot and dry. And they're getting some rains right now as we speak. But this is where I think the next 2 weeks, you start taking away that extra 6 million tons of U.S. production that USDA gave us on the WASDE report, and you start going negative, like take away 12 and you added the 6, all of a sudden you're deficit 6. I don't think the trade's prepared for that right now because the U.S. crop has gotten bigger and bigger and bigger in the trade's mind.
So I wonder, just to wrap that up real quick, do producers have their pencils sharpened and ready to go per se here over the next couple of weeks, and maybe not jump to making a move today, but being vigilant and being ready just in case, right?
I think that's a great piece of the puzzle because I had a great conversation with the client who was using a lot of accumulator contracts, and generally speaking, that means they accumulate and build up a short position, physical short position in their cash at much higher levels. But then there's a knockout price, and meaning it stops adding to his hedges. He got knocked out in that 4.25 range on December futures. And so our conversation right now is, okay, that 30% of the crop that you don't have hedged, we need to get something underneath us again, but we probably want to do it on paper. We probably want to do it with a bought put type structure so that we don't oversell our bushels. Because I've had a lot of conversations with producers since I've been well this week with the idea, especially irrigated producers, they just don't think they've got the yields they had last year because the early crop it did not come on as strong as last year. So do we really have the ear length there that early crop gives us? And I think we don't know that, but the idea is it may not be there. So let's plan that into our profitability and risk management standpoint, plan of action here as we go through this weather market.
All right, good thoughts. Let's go to livestock here. I want to make sure we have time for cattle and hogs. As we look at that cattle market, kind of a mixed bag on Wednesday. It's looked all right here as of late, but I feel like we're getting up against some resistance levels maybe again in fats and feeders. Talk about first what you're seeing, looking at cash cattle trade and some of the different correlations you're watching there, Mike.
Yeah, we really need the cash market to stand up because the seasonals are not the greatest. And if you would have talked to me 24 hours ago, I would have said we've got in the short term very nice tailwinds in the cattle market from the negotiated cash price having a $10 premium, from the feeder cattle placement number, from the cattle on feed report last Friday, and from the strong hog market and that strong belly market leading the cutout higher. We've only got one of those three now left 24 hours later, because the negotiated cash price took a real nosedive from about 195 down to 187 and a quarter on Wednesday afternoon. We don't want to see any more slippage here, because now all of a sudden we've got the cash and the August futures essentially running 1-to-1 with each other, Jesse. We want to keep the beef side of the equation running strong. And I think this is especially noteworthy as we get into a more wobbly stock market environment, as we get ready for the U.S. election, so on and so forth. And so I'm much more nervous about the feeder cattle than I am the fats, because of the feeders and the corn relationship and how they tend to play opposite one another with the funds and how the funds trade. Up until today, I was not nervous about the fat cattle at all. I'm not going to throw in the towel because we haven't done any technical damage, but I still want to really keep a close eye on this cash market at this stage.
Now, looking at an interesting chart here as well that you share with me, it's cattle and the S&P 500. What are you seeing with this chart specifically, Mike?
Yeah, I mean, we already know that the beef consumption is starting to get wobbly on us, and the seasonals, as I said, is going against us. The USDA came out on their retail report last week showing the featuring rate down about 8%. The activity in featuring, in terms of the number of sales out there and the number of items of beef for sale in any specific ad, was also down about 5.5%. So with demand starting to get wobbly and some of the economic data you and I have been talking about, I've really been keeping track of the stock market here in the United States and how it's been in its relationship with the live cattle futures. And on an 18-week rolling basis, that has gone from mildly negative in price relationship to sizably positive again. And so the stock market is a role player. It is a factor now in terms of making my determination on recommendations to get hedges in place. If it gets more positive in this relationship and that yellow line goes up back towards 90% positive, like we were earlier this year in February, March, and we lose some technical support levels here, I will want to address those back end cattle markets in April, October, those kind of deferred months, get some hedges in place, because I don't want to see any more slippage in the stock market at this stage of the game, because I've been worried about it for about 6 months.
All right. I want to ask you about the hog trade as well before we wrap it up here today. It feels like technically the hogs have found some good support here. We've worked our way off the lows. It's been more than 2 or 3 days of a move to the upside. So I'm optimistic in hogs in a market that's been widely beat down here this year. Mike, what's your thoughts?
Yeah, I mean, we've had a big run, and I think we're probably more range bound at this stage and not needing to catch up with the short mindset of the funds because we had China run us higher. I do think China is something to worry about. I would say, generally speaking, Jesse, if you see any kind of upside move of what we've recently tested and we go through those, hedge is probably a good idea. I would be more nervous about downside as we got into the first, second week of August. That tends to be when that BLT season kind of runs out of steam. And as I said, we're dealing with almost 140 bellies right now. It's really charged up the cutout. That's a seasonal to me. That's not something that says we've got great bacon demand. So play it very closely to the vest here as you get to the end of the month would be my general recommendation.
Well, there you go, talking bacon and BLT seasonals again, Mike. Now I'm hungry for BLT.
Good, good. Go get it.
It never fails. It never fails. Good
That's
stuff
right.
as always, my friend. Put a bow on this for us real quick. Any final thoughts you'd share or anything you'd want folks to really think about here this week?
I'll just reiterate the oilseed side of the equation. We've got some really short beans out there, and they can really bake in the sun if we get a hot, dry pattern. I'm not trying to shortchange the yield loss potential in soybeans and oilseeds, but globally, we're much tighter in corn than soybeans. And I think profitability-wise, you can match that up really nicely. This weather-led rally brings us back into some unbelievably good, profitable levels in soybeans that I honestly did not think we'd have another chance at. So I'm looking at this as a real gift in soybeans. So that's kind of how I'd look at it, Jesse.
Where could folks reach out to contact you, take a look at your analysis, and much more, Mike?
GlobalCommResearch.com. Great time to get a 2-week free trial. We won't bother you more than once to see if you like what you got and want to sign up, but please take a look at us there at GlobalCommResearch.com.
Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, my friend. Thanks for joining us this week. Appreciate it.
Thank you, Jesse. Appreciate you having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.